Assalamu alaikum friends, welcome to question number 50 from your SBR revision kit, Aron. And this question we are going to cover, as you can see that we have financial instrument transactions. So mostly we are going to cover IFRS 9, which is a challenging topic in itself. So make sure that you do this question fully and understand this question because financial instruments are complicated a bit to understand. And you need a lot of practice in this area, more practice than other standards, because some standards, right, by their nature they have more complicated and more things are there which you need to know. And if you see my lectures on IFRS 9, there are 10 parts to it. That is like one of the biggest lecture that I've biggest topic that I've covered. So yeah, and under this we have issues like convertible bonds, share exchange, then Winston bond. So these are the three issues we have, and the three requirements, if you see, they are targeting on these three separate paragraphs. First one is relating to convertible bond, second one is relating to share exchange, third one is related to Winston bond. Okay, so this will help you in order to plan your answer. You can write it in different order, you can write it in any order, in fact they are not related to each other. So requirement A, B and C requirements are same. Discuss the accounting treatment, discuss the accounting treatment, discuss the accounting treatment. For 31st May 2007, for 31st May 2007, here also it is for 31st May 2007. Okay, what is the accounting treatment in the financial statements of that particular thing? Both A and B are same, it's just the instrument, the item is different. This is for 9 marks, this is for 6 marks. Okay, by the nature also convertible bond will definitely be for more marks, because we are going to talk about debt as well as equity. Share exchange is just share exchange, it's just about equity. So 6 marks, and then the last one is for 10 marks. Okay, this is regarding Winston bond. Why 10 marks? Because here you have to additionally put one more thing. Your answer should explain the impact of the bond in the statement of cash flow. In the statement of cash flow is also there. Whenever they say financial statements, okay, you have to talk about two statements. One is the statement of financial position, the other one is statement of profit and loss and other comprehensive income. Those are the two things main. Statement of cash flow, you have to talk about it when additionally they have mentioned, like in part C. Part A and B, you don't have to talk about statement of cash flow, the impact on that. Only in the statement of profit and loss and statement of financial position. But part C specifically they have mentioned. That's why it's more marks, additional marks, 10 marks. So let's read, and this in any order you can answer, they are not related. But let's start with A first. Because it's my habit that I always do in the order, unless if I read something, for example I'm reading some case from A and I find that it's a little bit difficult, then I don't waste my time, I go to part B. But other than that, normally I try to do okay in the order, because anyway there is you have no option, you have to do it but now or later, so it does not make sense that I keep delaying. Okay, convertible bond. Issued 1 million convertible bond on this date, 1st of June 2006. They have 3 years. Okay, the term is 3 years and fair value is 100 million, which is also the par value. Interest is paid annually in years at a rate of 6%. You need to know all these things when it's a bond or convertible bond. Convertible bond, additional things you need to know. If it's just a bond, what is the interest rate, what is the term of the bond, the duration, the fair value. Okay, because it's convertible bond, you'll be given more options, like what it will be converted to, how much. So bond without the conversion option, just the interest rate is 9%. Okay, bond incurred issue cost. What is this? Now you will be having issue cost because bond you are converting to equities. Issue cost also will come with shares and all. Issue cost is 1 million. Impact of this issue cost is to increase the effective interest rate to 9.38%. At 31st May 2009, this is when? After 3 years from 1st of June 2006, right? When you're finally going to redeem the bond. But you have to calculate the impact on which date? Look at your requirements, 31st May 2007. Okay, after 1st of June 2000, it's just 12 months from 1st of June 2006. So at 31st May 2009, the bondholders can opt to be repaid. They can opt to be repaid the par value in cash, or they can opt to receive fixed number of ordinary shares in Aron. Out of these two things, they will either be receiving cash or either number of shares in Aron. So understood the scenario completely? Okay. Now this question is for how many marks? I think 9 marks. Okay. Which standard? Okay, remember whenever it's convertible bond, the standard that you are referring is IS 32. Because convertible bond means the issue is whether debt or equity. Whether you have to give it as debt or equity. You are presenting it as equity instruments or financial liability. That is the main thing. Okay. It is for convertible bond. If it's just bond, then it will be IFRS 9. Okay. So the main idea is they have liability and they have equity component. Okay. So according to IS 32, IS 32 says present them separately. You cannot keep them together. Liability component and equity component separate. So account for present separately. Okay. The split is made on the issue date. Now we are coming to this. What are the two components? Okay. So out of 9 marks, 1 mark you will get here. Just see how you're collecting marks. 1 mark to refer the standard and say that present this and this separately. 1 mark for that. Now we are coming to this. Okay, if you see the answer, just see the answer. Lots of it are for calculation. So this should be easier for you to get marks because writing part is not so much. But you start your answer not directly with the calculation, with saying that under IS 32, you should split the equity and the liability component. Okay, two components: financial liability, equity instrument. Okay, what is it? Explain. Financial because here you didn't explain properly what is financial this thing. You just told split. Now you have to explain what it is. Financial liability, just the definition. It is a contractual obligation to pay cash in form of interest or capital. See, when you're taking a loan, you have an obligation to pay interest as well as the principal amount the same way. The amount that you have to pay, the obligation that you have should be interest or capital. One of those two things then is a financial liability. If it's something else, then it's a different thing. Equity instrument. Contract to issue a fixed number of equity shares. You have a contract that you have to issue this number of ordinary shares. It's fixed. There is an equity instrument. You are defining here. Okay, to define that, another 1 mark. Define both financial liability and equity instrument. So the rest 7 marks are for your calculation. But understand how the 7 marks you can get and what are the 7 calculations that you have to do. Okay, first the question now comes, what do you start with first, equity or financial liability component? You start calculating with financial liability first, always, because equity instrument is the balancing figure. There is no method to calculate equity instrument equity component. Liability, yes, find the present value of cash flow, present value of interest and principal amount that you're going to receive in the future. As simple as that. Equity, there is no such method. That's why start with financial liability. It's not an option. You have to start with liability component only. Okay. So you discount by the future cash flow. Which discount rate should you use, by the way? There are so many discount rates if you see here. One is 9.38%. Okay, this is the impact of issue cost. That comes after conversion, 9.38%. Don't touch it now. Whether it is 6% or 9%. Between 6 and 9% is the question. 9% is without the conversion option, 6% is with the conversion option. It is 9%. 9%. You should take the 9% as a discount factor. Always your discounting factor will be the rate which is without the conversion option. Remember this. Today, remember this. Okay? I hope you'll remember this. So it's 9%. Discount future cash flow using this discount rate. You have to say which discount rate you are going to use to discount future cash flow. Which is the market rate that is for similar bond without the conversion right. Okay? And how do you find this thing? Here you will get 1 mark. Why? Because you are now telling how to calculate. You are explaining without calculating first. This is your explanation part. Then find the present value of future cash flow. Find the liability component. Equity component is what? Difference between cash receipt and liability is equity component. So already out of 9, 3 marks are gone by. Now comes your calculation. Difference between cash received, interest, and this thing. The amount that cash received will be given to you. Liability component you have just calculated. So deduct it, find the value of the equity. Because both equity and liability component, if you add, should be equal to your cash received. Now we are coming to the calculation. And see, another thing is where you have calculation and writing part. How do you approach this question in your CB platform, where you have to type in your Word, MS Word? Okay, these things you cannot do this in Excel. Don't use Excel for typing answers. Wherever calculation part is there, you can keep this in the Excel format. Okay, because the question asks impact and all, right? So to talk about impact, okay, this part, this you can do in MS Word easily. Calculation part, yes, you can. It's better, it is advisable to do it in Excel. You can do it in Word also, like you can type and then use a calculator, put the amount. That also you can do, but that will take more time. Okay, if you don't believe me, you yourself can do it and test it. How long are you taking in both? Use Excel on one side, time it, do same calculation and do it in Word. Like you're typing the figure, for example, 100 into 6% divide by 1. And obviously you need a calculator to get the answer because what you're just typing. Understood? Try both and see which one is taking less time. The one whichever is taking less time, you should do that in order to save time. Okay. You only need calculation, Excel for that calculation purpose. After that, you can shift it into the Word. Don't need to shift this whole thing. It's not needed. This whole table, you don't have to shift it in the Word. We only need the impact on the statement, the financial statements. So we only need to know these things, these entries. This you can write it in Word because now you know this figure. This figures now you know through Excel you have calculated. Now you can just type the figure or copy paste that figure from Excel. Just that figure, 100 million from your. I don't think it will take so much of time to type dollar 100 million. Or you can just copy paste from Excel also that 100 million. No need. These are just workings. This you can keep it in Excel. No need to take it in the Word. Okay, I will write it also for you. Excel, MS Word. It is not as advisable for you to do this in Excel, debit, credit, cash and all. You can do it, okay, but it's better to do it in Word. It's my opinion, this thing, okay. All those things, rest all, you can do it in this, what do I say, Word. This one also again, you can do it in Excel, okay. The only figure that you need is two figures you need from here, the interest and the closing figure. This and this you can type it in Word. Easily take the figure and just type it. Understood? And this same approach replicate for other questions. Maybe for other questions, I clearly didn't tell you this thing before, how to break down in Excel and Word, but you can use it, right? Okay, now things are easier. You have set up everything. Now you know what to do. Find present value, find the difference. Now apply it in the calculation. Start with dollar million on this side. Keep one column for dollar million. This you'll be doing in Excel. Okay. I'm assuming you're doing it in Excel and I'm explaining you. Present value of cash flow. See, present, right, like this. When you're doing it in Excel, even though Excel, okay, calculation only you need, but you have to write descriptions. You just cannot write, okay, one to in different rows, assuming that examiner will understand this is for year one, this is for year two, this is for year three. You have to write that this is for year one, year two, year three in a column. If you don't want to write year one, two, three, it's okay. Just write one, two, three. But it's advisable, okay? At least you can write y1, y2, y3. It's understood that is year one, year two, year three. Because bond, whenever bond thing comes, you need many years. Because bond is for 3 years. So 2007, 2008, 2009. Even though the impact they told just on 31st May 2007. See how students often get manipulated easily by looking at the word. Confused, I would say. They just told impact on 31st May 2007, right? In the requirement, but still you have to show for the other 2 years because the other 2 years that you are going to put for 31st May 2007, from 31st May 2007's point of view, they are your, what do we say, Long-term liability, you can say, right? Okay. Starting with 31st May 2001 at a time. You finish 2007, go to 2008. Finish 2008, go to 2009. Okay. So just this one. What is the amount? Okay. With this is very simple. The amount is given. Just take the take the interest, because first year and the second year you'll be paying interest, only the interest. Principal amount you'll be paying at the last year, year 3. So year 3 will be including two things: interest and your principal amount of loan. Understood? So first and the second year you'll be finding it similar. 100 into 6%, 100 into 6%. Just this will be to the power 1. Just this will be to the power 1. Oh god, my this thing is okay. This is to the power 1. This is to the power 2. Okay. Which percent should you take here? Question is which percent? You don't have to refer back to your this thing. You have already written it before. Which one you are taking here? You have already told 9%. 9% you are going to discount. So you see here, it's 9%, 9%, 9%. It's just the powers are increasing. 1, 2, and 3. Okay. Year 1 to the power 1, year 2 to the power 2, year 3 to the power 3. Only that is increasing. Rest all it is 9% only. Discounting factor 9%. But interest when you have to find out, okay. See, interest when you have to find out, you have to use this 6%. Okay, I will highlight it for you. It's not even highlighting. 6%. Interest is paid annually at this rate. That 9% interest rate which is given without the conversion is for discounting purpose. This 6% is to find the interest. Understand the two reasons why there are two different interest rate. And this 9.38%, this one is for the issue cost and all. We'll come to that after conversion. Now we didn't convert yet. Now we are in the bond part, working on the liability thing. We don't need that 9.38% at the moment. So, okay, I forgot to check the amount. It's always better to double check, okay? Because by the time you read the requirements, attempt, answer, write something, again you will forget the figure, actual figure. Again you have to go back and check the figure. So it is 100 million, fair value of 100 million. This is the amount, okay? So you check here. That's why it's 100, 100, 100. 100 is the principal amount. So 100 into 6, 100 into 6, 100 into... The interest will be 6% of 100. That means it will be 6, right? 6 is the interest. So now third year when you're coming, okay, just see. Third year when you're coming, this 100 is the principal. This 100 is the principal amount, okay, that you're receiving. And this is the interest component, 100 into 6%. So principal amount plus interest, okay, and then you discount it. Remember, when you're discounting it, it is not like this. Okay, I will show it. It is not like this. You are discounting and then adding 100. No. Both interest and the principal amount add and then discount. That means then divide by 1.903 to the power 3. That discounting should be done at the end. Okay. Just that means first 100 plus 6, because 100 into 6% is 6. So 106 divided by 1.09 to the power 3. And if you check the figure on your right, you will check that the highest amount is third year, because principal amount also you are recovering. So 5.5, 5.05 and 81.85. Add, that is your total liability component. Now do you understand? This is very simple. Just discount the principal amount and interest amount, add the 3 years figure, and that's your liability component. Okay, so you'll be very shocked if I tell you that the procedures are in 4 steps: year 1, year 2, year 3, and then the total. But mark is only 1 mark. Yes, it's very shocking. But that's how ACCA works. Only 1 mark for getting the total liability component. 1 mark. Don't worry, even if your total liability component is incorrect, maybe figure something is wrong, you will still get the marks for your working year 1, year 2, year 3. Even though maybe in addition something went wrong, your liability component you didn't add up correctly, it's okay. Maybe year 3 something went wrong in a particular year, it's okay. Still, if you get the other years correct, you will get marks. That's the reason why I always tell you do the workings. It's needed. Because through workings you can get marks. Even though if your final answer is wrong, it's okay. But because now you are doing it on a CB platform and you are performing this calculation in Excel, you should be very grateful for this. You should be thankful to God, I would say, because this saves your time, number one, and second, this makes you, it will not make you to lead you to make mistakes. Like if there is any mistake, maybe that mistake is because you have incorrect amount in your Excel in the formula. Otherwise, they if you put a sum function, they will automatically add it correctly only. Whereas if you used to do this manually, even in your calculator that is given to you, the online calculator, you still can do mistake. So this is why Excel is very helpful in this case. Very rarely students will make a mistake here because it's just a sum function when you're making the total liability component. So if your total liability component is incorrect, means something in some particular year went wrong. Usually accuracy, that adding thing will not be incorrect. I mean, yeah, this adding thing will be correct. There is no doubt about it. That means when your total liability component you are not getting, it is not your arithmetical accuracy. You have to check whether this are correct or not. And to check this figure, if you're not getting, you have to check these things. Then equity component, another mark. For this proceed of issue, you are not getting any mark because it's just the addition of two things. It should be equal to 100. You see, amount of the bond is 100 million, fair value of 100 million. So equity and liability at the end should be equal to 100. What you are doing through this is you are just dividing this 100. You want to find liability component, which is 92.4, equity component 7.6. And if you see, there is something very similar to each question. Your liability component will always be greater than your equity component. Okay, most of the time it is. Okay, so this is also a way to help you understand that if something is wrong or not. It will not help you to solve a arithmetical accuracy. Numbers might be wrong, but at least the amount, looking at the amount, you can doubt whether this, because imagine if it was the other way around. If your liability component is 7.6 and equity component is 92.4, then you can very easily tell something is wrong here. Why? Because your equity component is too high, liability component is too less. You should doubt this. So it should be the other way around. Liability component should be greater than equity component. This is another way of checking your answer. And then add and check at the end whether it's equating to 100 or not. If it's more than 100, if it's 101 or less than 100, 99, something is wrong somewhere. Either your liability, it's mostly your liability component that is wrong, because equity component is just the balance that you're finding out. If a liability component is correct, there is very rare chance that equity component can be incorrect. Understood? So how many marks you have collected till now? Go back 1, 2, 3, 4, 5 marks. Out of 9, 5 marks are there. Now the 4 marks. Okay. It is not that for each one you are getting one mark. Don't think like that. That if I debit cash, I will get 1 mark. Credit liability, no, it's not like that. Together they are taking 1 mark. If it's like that, they would have given you 20 marks for this. So many entries are here. You see? So now, entries that are required. Do the entries. This is the meaning of accounting treatment or entries or whatever. How do you do? When you are receiving bond, debit cash, because through bond you are receiving cash. Credit your liability and equity, we know it's credit. So now you know the liability, now you know the equity also. You have calculated it. And the issue cost will have to be allocated. The issue cost also have to be allocated between liability and equity. Okay. What is the issue cost, by the way? I have to go and check again. See, I forgot. You also will be forgetting this. Issue cost The impact of issue cost is to increase the effective interest rate to 9.38%. Definitely, I guess. Okay, just give me a minute. Okay, after posting the above entries, I will come back to this later, a bit later, the issue cost part. Okay, after posting the above entry, liability and equity would have been okay. Now you have to find the carrying amount of liability and equity because in the statement of financial position, you'll be putting the carrying amount. No, that means from your proceed, deduct the issue cost for both equity and liability. Now you know the proceed. Now you know the proceed. Okay, and you know the issue cost also for both equity and liability. So this is the figure which will go in the statement of financial position. Okay, so equity, I will come to the marks later, but first we'll go through this. Remember, equity, what is the equity now? This carrying amount. Equity will not be remeasured. Equity is not remeasured. It is only the liability that is remeasured. And liability is 91.48. This would be measured at amortized cost. You have to understand this liability component. It's a financial instrument. And liability component can be measured in three ways: fair value through profit and loss, fair value through other comprehensive income, and amortized cost. It is not fair value through amortized other comprehensive income, because if it was like that, they would have specifically told. And how do you know it's measured at amortized cost or not? These are the things you need to question also, and you need to know the reason also, rather than just memorizing that it will be at amortized cost only. Because you are holding this bond until 3 years, year 1, year 2, year 3. It's there with you for 3 years, and then you are converting. That means you are not selling this bond after its redemption. Then you are converting it into equity. You are receiving equity or cash, but you are holding this, keeping it. That means all this 3 year you are receiving interest and the amount of loan, principal amount. That's why when you are keeping it without selling the bond in between or after that, it is at amortized cost. This is the method that is used to measure liability. For equity, no such thing. Amortized cost. Okay, that's why. So for amortized cost, you need to know what is the meaning of amortization. In normal sense, if I ask you, or depreciation. You depreciate the amount. You will be given some depreciation rate or some amortization rate to depreciate or amortize your value of intangible or tangible assets. That means your value goes down by that percentage. Same way, this is a financial liability. Same way. This is the interest, 9.38%. So this cash payments reduce the liability. Reduce the liability because this is a liability. For normally we take it for assets. There also we reduce assets, no, by the depreciation rate or by the amortization rate. Same way for liability also, it will be reduced by this percentage, 9.38%. You have to take that effective rate. Okay, the cash payments reduce the liability. Obviously, when you are paying the amount of cash for the bond, okay, it will reduce your liability until it becomes zero. You'll be paying cash. Okay, makes sense, right? Now you have to calculate that. Remember, examiner told you in the requirement is given for 31st May 2007. We are only worried for that one particular year. Sometimes you might have to calculate this for 3 years also. You don't have to take it for 3 years and waste time here. Yes, here you need it for 3 years in this case. Why for 3 years? Because you want to find the total liability component. To find that total liability component there, you don't have to worry about the year. You have to take all the 3 years. If it's for 4 years, then 4 years. 5 years, 5 years. But when you come here, finally, for the amortization purpose, when you are taking it, measuring it amortized cost, then you are not taking 3 years, only for the date which examiner has asked, that is 31st May 2007. So opening will be 1st of June 2006. Obviously you need an opening for that. What is that opening figure? You have already calculated this, 91.48. This is this figure. Which figure? This 91.48. This you have already calculated from the 3 years. present value, deduct the issue cost, take it. That is your opening balance. Opening balance, not 31st May 2007 balance. Because you still have to amortize it. Understand? Now use this 9.38% amortization to this amount. And it will be 8.58 something. Keep it in two decimal place. It's advisable to keep in two decimal places. Don't write the full number. But in Excel, if you are performing it, okay, if you are taking 9.38% of that number, the amount will be showing up big. No need to include. You can just round it up to two decimal places. There is an option like that where you can do it. Then cash paid. Remember, interest, you have to add this with the opening balance, and the cash payment you have to deduct, because cash payment will reduce your liability. Okay. Because this is the method you calculate. Now when you're charging interest, it will be this 9.38% on this amount. Liability, 8.58. But because it's a liability, okay, you will be asking why this is not deducted, amortization, because it's a liability. If it was an asset, yes. Liability at measuring at amortized cost means this interest you have to add. It's like adding depreciation to your asset. But in liability, we add. If it was asset, we deduct amortization and depreciation from the carrying amount of the asset. But here we add. It makes sense, right? This interest you have to add with this opening amount of liability. And then we have cash paid receiving 6% only. Okay, the interest is given. You are just paying the interest, remember. You are not paying the principal amount on this date, 2006, right? On 100. So 6, just deduct that, and this is your amount. So now, in the finance, in the profit and loss, only this interest will go 8.58%. Not this. This is cash paid. That means interest you have paid. This interest, 8.58%, which you have just calculated. Okay. Why you cannot use 9% here? Sorry, 6% here, this interest? Because here it is measured at amortized cost. Amortized cost means you have to take the effective interest rate. Here you cannot take 6% any longer. You have to take 9.38% as interest. Yes, for cash paid, you are paying the interest on 100. For that, 6%, yes. You need a little bit practice in this area to understand these things very quickly. Which interest to take, which to discount, because most of the time students get confused. They might take 6% on that, or they might take 9.38% for the cash paid. So this mistakes you should avoid. Finance means interest, 8.5. Okay, this is the amount you are paying. It will go in cash, not that one, 8.58%. This one. This will come in your profit and loss. And what about the liability? It will go in the statement of financial position. What is the carrying amount on 31st May 2007? This amount. So this, for getting the finance and the carrying amount of the liability, 1 mark on for 31st May 2007. 1 mark. Then to find the issue cost, another mark, 1 mark. To say that equity will not be remeasured and this will be taken at amortized cost, another 1 mark. So how many marks? 1. Okay, we'll go from up. 1 mark, 2 mark, 3 marks, 4 marks, 5 marks, 6 marks, 7 marks, 8 and 9. Yes. So for all those things, you will get 1 mark. Okay. This accounting entry. Sorry, you will not get marks separately. For liability and equity component, you will just get mark here. And the issue cost, separation of issue cost and all, you will get another mark. Okay, I will break it down for you at the end. I will make a chart for you. Now comes the issue cost. Okay. Issue cost, if you see, if you see, you are crediting cash 100, liability, and this one you are debiting now. Okay, that much you understood by debit because you're paying in cash. Because they told convertible bond, the company incurred issue cost of 1 million. They have already told you 1 million. Okay, that means you have to credit 1 million issue cost. It will be going out from you. Okay, but then how do you find the liability component and the equity component? Obviously, if you find the liability component, equity component is just the balance to get 1 million. It is, if you see, the 0.92. How? How is it? There is something which we are missing out. See, this is a little bit tricky. It's hard to, it's not directly this thing, okay? The impact of the issue cost is to increase the effective rate to 9.38%. What is the current rate? 9%. The discounting factor. 9.38%. Just it has to be something to do with that 9.38%. Okay. Just okay. Think your ways. Think your ways around what you can do. Okay, good that I didn't come prepared for this question. If I came prepared for this question, I would have not understood the real struggle what students will likely to face. It's good that we are working this out together. Most of you will panic and leave this at this moment and go to the next. Right now, right? It's okay. There are so many ways you can do this. You just need to find out one by one. When I usually get stuck, I do one at a time. Obviously, it should make something sense, okay? So my worry is just out of this to just get one. If you just get one of it, you've understood everything. Okay, 1 million it is given. So the question is, issue cost is this one and the impact is this to increase the effective interest rate to 9.38%. So it is something to do around with this 9.38%. Okay. So we'll check. We'll find out this thing. 100, right? Issue cost is 1, so it's 99. Out of this, we'll find out what is the 93.8% of 99. If you see 9.38% of 99, what is it? It is 9.2862. Okay. Obviously, it cannot be 9.2. It should be less than 1. We know that, right? It should be less than 1. This one. And we'll do this for the others. 99. So this. Okay. Equity part, you don't have to worry. It's just a balancing figure. You will get it. But just okay, we'll just check this. Okay. And if you check this 9.2862 and 0.92, it is very much similar. It's just that it's one decimal place after. Okay. So some percentage. Okay, we'll try to do this with algebra. We'll keep this y the percentage, we don't know the percentage, and into 1 million is equals to 0.92, because at the end you have to get out of some percentage of this 1 million should be equal to 0.92, which is your liability. So if we take it the other way around, it will be 0.92 divided by 1 million. That means it has to be something 92%. 92% of 1 million, which is 0.92. Okay. And if you are taking 8%, okay, that shall be equal to 1. So if you are getting 92, this is 92 and this is 8%. 92 is something very close to 9.38. This is 92%. Okay, wait. So 1 million. Okay, just deduct it from your liability and check. Okay, this is another way which you can do. See how many ways I tried. I tried one, I tried second through algebra, didn't work out. Now I will try my third method. It's better that you try to do different methods while you're practicing, because in the exam you will not get so much of time to do all those things. Okay? At least you know that this method will work or not. Okay, so this is what I thought process. 1 million. Okay, so liability is 92.4. Okay, minus 1 million. Okay, correct, because now 1 million will go out, issue cost. Divide this by 100 minus 1, because 1 million will go from 100. So now the total amount will be 99. Find this in terms of percentage, how much it will be. Obviously into 100. So if I do this, then I am getting 0.92, isn't it? Then I am getting 0.92. Can I try this for the issue cost and see? Sorry, the equity part and see? Even though it's a balancing figure that we know, but better. See, now I got, if you can check the answer, I got 0.92. Same as the answer. But don't be so happy, because sometimes you might get the amount, okay, through some way, but it might not be correct. Like technically, the principle, it might not be correct technically. Right, you might have applied the wrong principle or something. You have done addition, deduction, multiplication, division, somewhere something you have done, but in this case it is applicable. Why? Because it makes sense, because they told 1 million is the issue cost, so 1 million will go, just cut off that 1 million from the liability and take it as a percentage of amount of cash, which is 99, because now your cash will be 99. Out of 99, what is the amount of a liability, which is 0.92. Okay, makes sense, right? Now we'll check the equities. It is 7.6, so same way we'll do for this also. 7.6 minus 1, your cash will now be 99. Out of this, what is your equity? That means out of your total cash, what is this thing? It will be, what is it? 7.6 minus 1 divided by 98. It will be 0.0 something, 0.07 or something. Okay, it's okay. It is because of decimal places and all, it might not come, but still you are getting. But equity part, you don't have to worry so much like this. 7.6, because this 7.6 you will not get the accurate 0.8, you will get little less than that, because this amount 7.6 also, it's a balancing figure. And when you're taking that equity, you didn't take the whole amount, so because of this amount is little changed. Because of that, this decimal answer also will be little changed. But at least for equity part, liability part, you can work it out, like this, because equity is the balance. Okay, so if you work it out it like this, you will get the marks, and then deduct that issue cost from the liability and get the amount. Okay, basically here we are taking it in terms of percentage to find the proportion. After that, once you get it, deduct it from the liability and equity component. Okay, but we need it in terms of percentage, that's why we took it out of cash, that liability minus 1 divided by 99, the amount of cash, to find this in terms of percentage. Because what is the percentage of this to get it in liability and equity component? We wanted that. Once we get that, once we have allocated it, take it and deduct it from liability and equity. Okay, the proceeds, not the 100 million. Now I will summarize everything what I've discussed. I've taken more time in this question because rest are easier. I will not take so much of time in other parts, so don't worry. Even if I've taken, let's say it's going to be 50 minutes for this first part, so 1 mark, this one I will write it here. I think this shall make sense. 1 mark, split equity and liability. Standard that I'm referring is IAS 32. Second, just count. Okay, 1 mark for each. There should be 9 points. Don't check out my lens. Lens could be more or less. Financial liability equity instrument. Definition of liability and equity. 3rd mark. How to measure liability and how to measure equity. That means find present value, and this one is the balancing figure. I'm writing this point so that you can use it for the future reference for any similar questions like this. Then we went to the calculation. Calculation of liability and equity. 5. Allocation of issue cost. Six, carrying amount of liability and equity after issue cost, after you deduct issue cost. 7, measurement. measurement of remeasurement, I would say, of liability and equity not remeasured. To say that also, even though you're not remeasuring it, it will remain same. To say that you will get marks, 8 marks, 8th mark. Balance at 31st May 2007. And finally the 9th mark. Okay. That was the last one. Carrying amount on 31st May. Okay. Sorry, this you can say that it will be amortized cost also I can take. Remeasurement amortized cost. To find that amortized cost, you will get marks. Okay. One is to say that it will, you have to take amortized cost. The other one is calculation of amortized cost. Okay. This I will cut. Calculation of amortized. Okay. Then okay, I hope you can see it's very small, right? Then 31st May balance. It's not writing anything. May 2007 balance. See how the 9 marks are there. Now immediately without wasting time I will go to part B because A I've taken so much of time to explain A. Shares in smart. We didn't read. I need to be a little quick because we are taking so much of time. So share exchange. So share exchange, they hold 3% of shares in smart. Okay. 3%. The investment was decided okay, it is fair value through other comprehensive income, this investment. And fair value was 5 million. Cumulative gain, it is obviously it will go in other comprehensive income because it is fair value through other comprehensive income. It is held in equity is 400,000. Whole of the share capital was acquired by given. Aron received shares in given with a fair value 5.5 in exchange for holding in smart. Right. Aron is having shares in smart and whole of the share capital of smart was acquired by given. Aron received shares in given with a fair value of this one in exchange for this holding in smart. That means to give a currently, can you understand this thing? It's too many of this thing. Aron is currently having shares in smart, but smart is taken by given. Now Aron wants the shares in given. To get that share, they have to give up their holding in smart, that 3% holding. This is the whole scenario. Okay, if you can understand. Aron have 3% in smart. Okay, now this smart is taken over by given. So A wants in this one give. So to get it in give, what he has to do? He has to give up in S the 3% to get in G, and fair value is 5.5 million. Okay, this is the whole thing. This is a share exchange. Share exchange with standard. Don't see the answers always with standard. Again, it's the same standard. Okay, shares in Smart. What kind of transaction is this? This is not a financial liability. This is not an equity. This is a financial asset. If you can understand this, it's a financial asset. You are having shares in another company. It's shares because through that you can receive income, right? Dividend. So it's a asset, financial asset. And this is for, I think it's for 6 marks, I assume. Yes, it's for 6 marks. Okay. So once they give up the shares in Smart, can they recognize it anymore? It's like they have given up the shares, financial asset they have given. They have they have sold. So what should they do? They have Aron has to determine if the transfer of the share in the Smart qualifies for derecognition. Exactly. Now you have given up the share. That means you have sold the share. So can you still recognize it in your financial statements, or you have to derecognize it? You have to determine this. You just cannot immediately start derecognizing. There are things which you need to take into account before you derecognize. What are those things? That is explained in this paragraph. First paragraph. If all the risks and rewards has been transferred relating to that asset, then the asset is derecognized. You need to mention this thing. This is a knowledge from your IFRS 9. For what asset derecognition? If risk and rewards have been retained, then what? Then asset is not derecognized. Simple opposite. So in this case, transfer of share, does it qualify for derecognition or not? What do you think? It does. It does qualify for derecognition. They are selling the entire 3%. That means they no longer retain any risk and rewards of that ownership. If any changes in the fair value of the shares, it will not impact on Aron. Aron has sold that 3%. They are not going to receive anything from it. There is no risk also if share price goes down. So it qualifies for derecognition. To say that it qualifies for derecognition, 1 mark, just 1 mark. Whether it qualifies for derecognition or not, 1 mark. First paragraph is only about that. So much to write, right? It's true. You have to write a lot just to get 1 mark. That's why ACCA is, I guess, it's a challenging paper. Second, they have also received something, no? They just didn't give up and wait. They were sitting, no, they got another share in another company given. Talk about that in second. Another mark is here. See how they have written it in different paragraph. First paragraph, derecognize. Second paragraph, recognize something. So they have obtained a new financial asset. That is the shares in the given. Mention the name of the company also. So financial asset, now all the recognition measurement you have to talk about here. Financial asset you recognize initially at fair value. Correct? Initially it is at fair value. So the shares, that means should be recognized at 5.5 million initially. Correct? If not held for trading, that means we don't know whether this financial asset you are holding it for trading or not. That's why this additional point you are adding here. We don't know. Sometimes you might not held it for trading. There is a different rule on that. If not held for trading, a designation could be made upon initial recognition. That means in that case, you can decide that fair value through profit and loss. Sorry, you will recognize a financial asset at fair value through other comprehensive income. That means any changes in fair value will go to other comprehensive income. That is the meaning of financial asset at fair value through other comprehensive income. That is for the new financial asset, the shares that you have got for you receive for given. It's a financial asset. Okay, why? Because from through that share you are going to receive dividend any amount, or you are going to, you have an obligation to receive cash. Sorry, you have a right to receive cash. That's why it's a financial asset. Okay, on initial recognition, this is we are talking about this designation. So for that, 1 mark. Initial recognition of financial asset. See, it could be through profit and loss, through other comprehensive income, but if not held for trading, then through other comprehensive income. If uh, nothing has been mentioned, just they told at fair value, means it will go to fair value through profit and loss only. Even if they don't write through profit and loss, it is the default position is fair value through profit and loss. Amortized cost does not come here. Amortized cost comes for financial assets which are in debt instruments. For example, bond. You are giving bond to someone, you are giving loan to someone. In that case, then amortized cost comes. Here, amortized cost does not come. Here, it's an equity instrument, shares. The only question is whether fair value through profit and loss or fair value through other comprehensive income. Now, why through profit and loss other comprehensive income? Because shares, okay, shares, usually people don't hold shares for trading, no? It's not every day. They might sell, they will buy later somewhere else, again they will sell. For short time they are keeping. That's why they told, if not held for trading, other comprehensive income. If you are keeping it for trading, then profit and loss. That's it. Only two things are there. Maybe I didn't explain this well in my lectures also, the way I'm explaining through revision series, revision kit questions. So this is the best way to take the maximum knowledge when I'm doing a question on revision kit. Because there I explain some things which I don't even explain in lectures. Maybe I forgot, but I will try to, inshallah, make videos more on such lecture. I will try to make it short and be more specific, and I will try to make it more easier. Okay, why it is like this and all. So another mark. Now third, when you're disposing something, obviously some profit and loss you will be assuming, right? So profit, that you have to find out. In this case it's a profit. So profit on disposal of 0.5 million will be recorded where? In the statement of profit and loss. Another mark. How are you going to get the profit? Difference between the initial carrying amount of the shares in given and the carrying amount of the shares in smart, that you have de-recognized. The amount that you have recognized in shares versus the amount that you have de-recognized in the smart. Find the difference. That is the profit on disposal. Profit on disposal will go to profit and loss. There is no doubt about it. Why? Because you told fair value. Initially recognize at fair value. This option you told fair value through other comprehensive income only if it is not held for trading. But nothing, they have not mentioned anything about trading and all. Default position fair value through profit and loss. Understood? Fair value through other comprehensive income comes in rare cases. If it is like this, they will give you that it is not held for trading or it is designated like this. Otherwise, default position always take profit and loss. That's the safest side. Don't take other comprehensive income. That's why they told profit and loss. Okay. So how 0.5? Because you are taking shares in given at 5.5. You are derecognizing and smart at 5. Right? So debit asset, credit financial asset. You are derecognizing an asset and you are recognizing an asset of a higher amount. Difference is it's a profit, right? 0.5. So to find that profit, another 1 mark. Profit on disposal. If you know like this, if you know the main theme in a paragraph, you will be able to explain better. The main reason why students often don't know how to write an answer, even though they know the knowledge is there, they have a proper understanding, they understood everything, they don't know how to summarize it in for 6 marks, and they don't know in points to write exact points. They don't know what they're writing in a paragraph. They don't know, just for the sake of writing in paragraph, they write the same point, they just divide it in different paragraph and write the same thing. Is like beating around the bush. That you should not do. Each topic is talking about each particular point and you're getting marks. Okay, so it's not like line by line, 1 mark, 1 mark, 1 mark. In that case, how are you going to get 6 marks now? Or maybe let's say, because this is 6 marks, okay, so sorry, 3 marks, so maybe they will get 2 marks for this calculation also comes for writing that. And now for the calculation part, 3, you will get 2 marks for this entries. Okay, because profit you have already told about profit, but debit financial asset and credit financial asset, for these things entries, another 2 marks. So out of 6, 5 marks are there. Entries, journal entries, 2 marks, and finally 1 mark. You see, out of 6, 5 marks already gone by. 1 mark is for what? In addition, they may choose to make a transfer within equity of cumulative gain recognized up to the disposal date of 400,000. What is the gain there? Already they have a cumulative gain in other comprehensive income. What is it? 400,000. Now they can choose to make that transfer within equity of cumulative gain. That means this profit on disposal, they have 0.5 up to the disposal date. That means on the disposal date it was in other comprehensive income till then, but now it will, you might change it to equity. From it might no longer stay in other comprehensive income, you might transfer it within equity, it will go to equity, right? So you can choose to make this transfer. It's a choice. To write that choice, remember when you have something compulsory requirement is there, for that also you will get marks when you can choose whether this or that, especially when disposal comes. For that also stating that you will get additional marks for that. So for the otherwise they would have not written that line. Every line is very important, so important. It is very carefully designed. The answers that is given to you. So for this 1 mark. Okay. What do I say? Choice of transfer from OCI to equity at disposal. Transferring what? The gain that is recognized in other comprehensive income. Okay. Here they have told in the tutorial note, they just have told if it is measured at other comprehensive income, okay, remeasurements to fair value will go there. Okay. Before the disposal. But however, the fair value that you have received exists the fair value of the share that you have disposed of. That's why the excess goes to profit and loss. Okay. Now, investment in bonds, the third one. And this is for 10 marks. There's a reason why it's for 10 marks. It has Winston bonds. Okay. Purchase 10 million. Okay. It is regarding video games industry. This is how you read. Quickly skim. Purchased how much, which industry, what is the rate, what is the redemption rate, what is the date, how many days, effective interest rate, all those things. Okay. The bonds are to be redeemed. Bonds are redeemed at premium on 31st May 2009. 5% interest. Effective rate is 15%. They are holding it until the redemption date. They will always tell you that they are going to keep it until redemption date or sell it because you need the business model. Why? To measure. You need to know through business model whether you are going to measure it at amortized cost of fair value through other comprehensive income or fair value through profit and loss. That's the reason. Here they are holding it until redemption date but will sell prior to maturity. That means before the redemption date you are going to sell. Often they hold it until redemption date, but in this case, before the maturity, they are going to sell the bond. That means you cannot use amortized cost. If investments with high returns become available, Western bonds are deemed to have a low credit risk at inception. Low credit risk, the bond. Now you understood what is the whole thing about. It's about credit risk. It's about impairment of financial asset. The main topic is this. There might be other things also, but that's why it's for 10 marks. Impairment of financial asset. If you see this question, all the three requirements are talking about one IFRS 9 financial instruments. Yes, it could be. They could test one particular standard in different requirements like this. In one, for example, this is question 3. How do I know? It's 25 marks and no professional marks. So it's question number 3 from the section B. They can test, or they might test different standards in different requirements. But if you see the 3 requirements, they're different from each other. First requirement is only on what is it? Convertible bond, equity and debt. Second is share exchange. You are de-recognizing a financial asset, recognizing somewhere else. Third one is impairment of financial asset. Even higher than that. Even higher than financial asset. Because this is most of the, what do I say? Most toughest area after hedging. Okay. Under financial instrument is this one. Impairment. I will not say very difficult. You will never understand. No. If you have understood, the beauty is you can score very well. Why? Because they usually don't vary. The variability of this question is less. It does not vary so much. It remains fixed standard type of question only they can ask from this topic. Even though it looks tough from the outside, but questions that they can ask are very similar. If you see for impairment, that's why this is an easy thing to get marks because you know how answer looks like. Okay. It's a financial asset. Financial asset in what? In a debt instrument because it's bond. That's why we are talking about impairment of financial asset. If it's an equity, shares, you will not have an impairment of that financial asset. Impairment can only happen for debt instruments. Only debt instruments like bonds and loans can have credit risk, right? Makes sense. So yes, on 31st May 2007, this is after 1 year. This is all the information till 1st of June 2006 till 31st May 2000. This is after that day onwards. So on this date, they received interest due on the bond, but there were wider concerns about economic performance and financial stability of video games industry. They're trying to show that it's risky. Sometimes industry, if it's risky, interest rate goes up. If interest rate changes, value of a financial bond will change. Understood? So this is the impact. As a result, the quoted prices investment of versus 9 million. Now, earlier you have purchased it at 10 million, the bond. Now it became 9 million, went down. It's bad or good? It's bad for you. It's bad for you who are giving financial asset. For you as an asset, now you're going to receive less cash. Although a pricing model developed by financial controller reserve management estimates value holding at 9.5 million. Some financial controller has value that relies on management estimate. Like internally, if you go by the management, they have valued it at 9.5, but market says it's 9 million. So based on their strong working capital management and market optimism about their forthcoming product, the bonds are still deemed to have low credit risk. Based on what? Whenever you say something that this is in the future it will be like this, it have to be based on some decision, right? So they are basing their decision based on their strong working capital. They believe they have strong working capital and they are very optimistic about the market. So because of that, they are still saying bond as low credit risk at this date also. Financial controller calculated the expected credit losses. What is this for 12 month? 0.2, lifetime 0.4. Lifetime is more than 12 months if it exists. And that means your financial debt instrument like bond impaired significantly, credit risk increased significantly, then you apply this lifetime expected credit losses. Whether we should do it or not, we'll see. For 10 marks, that means 10 different points. I will see whether marking scheme is given there or not at the end. No, so it's 1 mark per this thing. So now check the answer. Investment in bond is another thing. Loss allowance is another thing. Separately, you have to say statement of cash flow. They told add this also, the impact of statement of cash flow. Why? The amount that you're going to receive or you have to pay will change now. Okay, and working is there obviously. Working is only just one working. Divide it like this. Few marks will go for loss allowance. In fact, a lot of marks will go. Statement of cash flow, only few marks. Okay. What could impact on the statement of cash flow? What do you think when you're taking a loan or a bond? One, the amount of principal amount that you have to pay. One, the interest. So the interest received, you are going to receive interest now to the bond. That interest received will be shown as cash inflow from investing activity. Remember, interest received goes under investing activity. You have to know this classification. I know I'm going backwards. I'm starting with statement of cash flow. Why? Because statement of cash flow is something very easily you can understand. Even without going through IS 7, you don't need the knowledge of IS 7 here. You just need to know that where it is recorded. It's not you're making a statement of cash flow. No, no, no. You're not making a statement of cash flow here. They just ask what is the impact. So interest received will be one impact through bond. This amount will calculate later. Now if I calculate, you will not understand. Because impairment is also there. So this will be shown as a cash inflow. You are receiving investing activity. Interest received, dividend received, investing activity only. Nothing to touch with operating and financing. Remember it. And what's next? The amount, the cash spent on financial asset. This will be presented as cash outflow from investing activities again. This amount also will calculate later. But now you understood only these two things. So one is cash spent, one is this one. For this you are getting 1 mark here, 1 mark here, 2 marks. 2 marks. Out of 10, 2 marks is here. Only 2 marks. That does not mean that Investment in bond and loss allowance for 4 marks each. You cannot equate like that. Yes, sometimes it might be equal, but sometimes it might be more towards one particular thing. If you see here you have to write more. Investment in bond. So start before going to loss allowance. Directly start with the investment in bond. What is it? Always start with the initial measurement of financial asset. This should be your starting point. It's a financial asset, understand? Investment in bond. Initial measurement. So initially financial assets are measured at fair value. What is the fair value? 10 million. Isn't it? It's 10 million, no? Initial. 1 mark. Count the number of points. Okay? Each point 1 mark. Okay? I will not repeat this. Second, talk about business model. Because for later recognition, when you have to subsequently remeasure it, you need to know the business model. So second is business model. Whether you are selling it, keeping it, and based on what. So business model involves both holding the debt instruments and selling the asset. You're keeping it to collect cash flow and then you're selling it. So as a debt instrument, it would obey the contractual terms, compromise the repayment. Okay? Looking at the debt instrument, because as a debt instrument means you have terms, you have the obligation, or I would say not obligation, you have the right to receive principal and interest from that bond. It's an asset for you. Therefore, the asset should be measured at fair value through other comprehensive income. Okay? Because it's business model, other comprehensive income. Why fair value through other comprehensive income? See, when you are keeping it, this is a debt instrument and you are selling it, it is fair value through other comprehensive income. Understand this thing. It is not through fair value through profit and loss. It is either amortized cost, either this one. Fair value through profit and loss, if it is there, they will specifically tell you that it is recognized under this. Specifically. Those are other financial assets that are not in amortized cost also, not in fair value through other comprehensive income also. Otherwise, when you are selling it, fair value through other comprehensive income. Why? There's a reason for this also. I have thought about it logically. It is not written in any way in the book. No one has told me this. I was thinking, why other comprehensive income? Then I understood that financial asset, debt instruments. Do you keep it for trading? No. You usually don't keep it for trading. Normal conditions, you don't keep it for trading. You sell, buy, sell, buy, sell, buy. That's why other comprehensive income. If it was for your trading activity, then it makes sense to make it under profit and loss. Understood? That's the reason. In this way, if you know, you will memorize it better if you know the reasons also. But reasons are not needed. Okay, you don't need to know the reason. This is from I have just told you for those students to know why it is other comprehensive income default position. So for that, this is in one paragraph. There's a separation is because when I was copy pasting it, it came in a different page. That's why. Then third is here. Next to it only I will write the points. Okay, 1 and 2 is above and third is from the next page. So this will make you easier to understand. Now you know. Okay, what is next? Financial asset is a debt instrument. Remember, debt instrument has an interest with it. Interest income, you are receiving this interest income. You are receiving the amount of fair value and the interest. So this interest income. Third is interest income. This should be recognized where? Profit and loss. Why? Why? Interest income goes to profit and loss. Only if anything changes to fair value, that remeasurement of fair value will go to other comprehensive income. Please understand this. Just because this is other comprehensive income, this is fair value. Does not mean interest income also will go there. Interest income will be going to profit and loss only. Using what? Effective rate of interest. Okay, always effective rate of interest. They will give you that. They will provide you with that. So at the reporting date, that means at the year end. You can even mention the date also if you don't want to say the reporting date. But in the answers, it's written at the reporting date. That means 31st May 2007. The asset should be remeasured to fair value Okay. With the gain or loss recognized in other comprehensive income. Remember, gain and losses, because changes in fair value will go to other comprehensive income only. But at the end, again, you have to remeasure it to fair value, no? Because fair value will change, keep changing. So that's why remeasure. And gain and loss will go to other comprehensive income, because when you change to fair value, definitely some gain or loss. It will go up, it might go down. So this gain or losses will be recycled to profit and loss if the asset is disposed of. Remember, when you're disposing the bond at the end, whatever the gain and losses is there in other comprehensive income will be put to profit and loss. Okay, it will be recycled. There are some items which are not recycled, some items which are recycled. You need to know which items are there. In fact, I have explained it, I think, under IS 1. So yes, for that another mark. Yes, remeasurement of asset, remeasurement of fair value. And okay, 4 5. What is the interest income? Working one is there for this interest income. It is 1.5. Recognizing profit and loss already. Remember, you have to first, you wrote it will be recognized in profit and loss. Second, you have to calculate and show the amount. Okay. So first we'll go down to, if you see working one, don't put your workings in your main answer. This you'll be typing in your MS Word. Working will be doing it in Excel. Okay, and from Excel you can just take the amount 15 million, just the opening balance maybe. Oh sorry, interest, you need interest. Only this amount you just extract it from Excel. Just type it in Word 1.5. But you need this steps in Excel to get this interest. And keep the closing balance also. You need the carrying amount. So working one, mention like this, working one, and for what item? Financial asset. And mention the part also. This is for part C. When you're using it in Excel, I'm telling you. These are the things you need to know when you're doing it in Excel. Properly labeled. Part C, this, because there are 3 parts. You don't know for which part Excel you are using. There is only one Excel sheet and 3 requirements. You need to write which requirement you're talking about. This is requirement C, financial asset. So starting with opening balance, then we have another column, interest. Okay, always interest charged on opening balance, then cash received, then the total, then the loss, because loss is added because of impairment, then the carrying forward. Write the dates, year, date, and the month, rather than writing opening and closing, because you don't know what is opening, what is closing for you. The date. In order not to get confused, write dates and write properly interest. Don't just write figure 1.5, 0. Write the proper heading for it. 1.5, what is 1.5? Is it cash received? Is it the loss? Is it the interest? Who knows? So interest, how did you calculate interest? Right, just right next to it only 15%. Right? Is it, well, just again I will check the, because I forgot. Okay, this is normally you also will be doing. I forgot the percentage. What is the percentage? It is 15%. Effective rate is 15%. So apply 15% on 10 million, 1.5. Cash receipt is 0.5. We'll come to the loss on that later. Okay, but immediately now, working should be always presented at the end. No need to do this working at the end also for you, because you will be doing it in Excel. There you can write working one and all. But when you're writing here in the Word, how do you understand that you have done the working in Excel? How do you refer it to the Excel? Just write next to it working one, so that when someone opens the Excel and goes through working one, they will know how their interest is, they have got the interest. Next to it, if you write working one, that's enough. Or you can write working one Excel, that's up to you, it's okay. Fifth, IFRS 13. Apply the knowledge of IFRS 30 fair value, because they have mentioned something. How do you know IFRS 13 you have to apply or not? Usually when fair value is given, you don't apply, but in this case you have to apply. Why? Why? I will tell you why. If you see here, they have told that based on the market, price is 9 million. Based on the amount value they have calculated, 9.5. There's a difference. Can you see? Which one to take? Which fair value to take? That's why. That's why you have to talk about IFRS 13. Which measurement you have to take? If this was not there, if they would have given you just one, that fair value is like this at this date, then no need to talk about IFRS 13. But here you have to talk now. because based on that standard also, what will be the fair value? Another standard under this, two standards. So IFRS, what does IFRS 13 says, by the way? Definition: price paid and paid when an asset is sold at orderly transaction between market participants at the measurement date. This is the definition of fair value. Everywhere it is used, always it is used. Then come to the main point. IFRS 13. Three levels are there: level 1, level 2, level 3. Okay. We don't have to talk about each three levels. In this case, entity always wants you to use level 1 input when you are measuring fair value. In this case, level 1 input is used. Why? They have already given you the quoted prices. That is 9 million. The quoted price. This is level 1 input. Okay. Level 1 means for identical assets or liabilities. It's like identical twins. Identical cars, identical phones, same model, same color. Everything is same. There's no difference. Take the price, quoted price. That is known as level 1. So in this case, you have got the quote price as 9. This is a level 1 input. So this is the fair value that should be taken in the fair value measurement that should be reported in the financial statement, because entities will always prefer level 1. If even if you got the information through level 1, level 2, level 3, three different fair value, entity will always prefer level 1 over level 2 and level 3. If level 1 is not applicable, then level 2. If level 2 is also not applicable, then comes about level 3. If level 1 is there, you should not use level 3. Okay. That means you have to remeasure the asset to its fair value of 9 million. When you remeasure the assets to its 9 million, there will be a loss of 2 million. This 2 million is also recorded. And where will the loss go? Other comprehensive income, because we told changes in fair value. Other comprehensive income. How the loss is 2 million? Again, working one. So like this, if you put, already you have done this working one. Once you have done it for this one, loss also will be there. Same Excel only. Open. Cash is received is 0.5. How? First find out this. See, the loss is easy because you know the closing balance of this date is 9. And once you have got this cash received, this is the total. So the difference is loss. From this date to this date, it reduced. So it's a loss. We'll come to cash received later. 0.5. So you see 5 marks out of 10 marks is just for the first part. That is your investment in bond. And 2 marks went for statement of cash flow. So 5 and 2, 7. 3 marks will go for loss allowance. In that way. Okay, that means remaining 3 is for loss allowance. But we'll see how. 5, 6. With standard IFRS 9, immediately IFRS 9. What does it say about loss allowance? That means it says that loss allowance, okay, is recognized on investments in debt that are measured at amortized cost or fair value through other comprehensive income. See, loss allowance, that means impairment. In other words, your financial instrument is impairing. Investment in debt, bond is impairing only when it is measured at amortized cost or fair value through other comprehensive income. If something is measured at fair value through profit and loss, debt instrument, for that there is no loss allowance. That cannot be impaired. Understood? Understood? Okay. That's the thing I wanted to tell you. There's no allowance for that. Only for this two. If it is measured at amortized or fair value through other comprehensive income. So always you have to see debt instruments are measured at fair value through other comprehensive income. If yes, impair. Amortized cost, if yes, impaired. If it is profit and loss, no, you cannot impair it. No impairment comes. No loss allowance comes for that. Remember this. So for this, stating this principle from IFRS 9, you will get 1 mark. Loss allowance for amortized and OCI. 7. 7 and 8. So now we'll talk about credit risk. If it did not increase, because loss allowance, immediately talk about credit risk after you have talked about the principle from IFRS 9. Credit risk does not increase significantly since initial recognition. They told, right? That means the loss allowance, if credit risk did not increase significantly, means loss allowance should be equal to 12-month expected credit loss. If it increased significantly, then lifetime expected credit loss. So to mention that, another mark, 12-month expected credit loss, because they told significantly it did increase. Then, okay. So credit risk at the reporting date also it remained low, suggesting that there is no increase in credit risk. It suggests that there is no increase in credit risk. That means loss allowance should be 0.2. It is there already calculated in working one. Sorry, this 0.2, 12-month expected credit losses, this loss allowance, I'm sorry. This loss allowance is already given to you. I'm sorry. But if you see, it is matching with the amount that you have got there also. Right? Coincidentally, if you see it's there, same in Excel also you will get. No, sorry. There, sorry, I'm sorry. There it is 2. I'm sorry, I got confused. This is 0.2. Okay, this is the credit loss. To say that you have to take this, yeah. No additional mark for this, okay? Because this is just like the repetition. Here you have just told the 12 month expected credit losses you are taking. Okay. At initial recognition, here you are talking about initial recognition. Here talking about the reporting date. At both, it is credit risk is this one. Now, last point is for this. When financial asset is measured at fair value to other comprehensive income, loss allowance is not adjusted. Final mark is for this only. This paragraph. Remember, when it is other comprehensive income, loss allowance is not adjusted against the assets carrying amount. That means you don't deduct the 12-month expected credit loss from the carrying amount of the asset. Okay. It is for this type of asset, which is other comprehensive income. In this case also, it is other comprehensive income. Therefore, you do not adjust loss allowance from the assets carrying amount. Otherwise, the asset will be held at below fair value. Why? Why does it makes sense? Because you told fair value through other comprehensive income. If you do it in that way, you deduct 0.2 from fair value. Then it does not make sense. Then it will not be held at fair value. It will be held below fair value. That's why. Other comprehensive income, do not adjust. But if it was amortized cost, it makes sense. Amortized cost. Then you can deduct it from the assets carrying amount. Therefore, the loss allowance is charged to profit and loss. Immediately, you take that loss allowance as an expense in profit and loss. Loss allowance will go to profit and loss, not other comprehensive income. Only changes in fair value. Okay. With the credit entry being recorded, credit entry is there in other comprehensive income. Okay. If it is debited in profit and loss, somewhere it has to be credited. Okay. Essentially, this adjustments reclassify 0.2 of the earlier downwards evaluation of the other comprehensive profit and loss. Okay. It will be credited. Okay. Essentially, this adjustments reclassify. Because of this adjustment, you have to reclassify the 0.2, okay, from other comprehensive income to profit and loss. Okay. 0.2 from where? Other comprehensive income. How do you have things in other comprehensive income? If already earlier there was some downward revaluation. I'm sure most of you didn't understand the last point. Okay, this is like measurement, finally measurement of this thing. See, I will show you this with a number because we are over almost, right? Imagine in OCI there was some fair value loss. Where will that loss be recognized? Where that debit will go? let's say it is 0. It is 0.5. Okay, two examples I'm giving. One more than 0.2, the other one is less than 0.1. Already there's a downward revaluation, means it's a loss. It will be recognized in OCI 0.5. Okay. So this 0.2 has to go to profit and loss. That means from this thing. From this 0.5, you deduct 0.2. This will go to profit and loss. That means this 0.5 will fall down to 0.3. From here, 0.2 will go to profit and loss. Okay. 0.2 of the earlier downward revaluation. From the earlier downward revaluation, if there is anything in other comprehensive income, it will now be reclassified to profit and loss. Okay. Why? Why? You are crediting this. Correct. You are crediting this. Because here it's a loss. Here you are taking it out, means you have to credit. Here it is debited. Why? You are selling. You are selling the bond. That's why you have to take it out from OCI to profit and loss. Okay. If it was, let's say in OCI it was 0.1. It's a loss only. Okay. Taking a bracket. Profit and loss. Okay. Loss is 0.2. Out of the 0.2, only 0.1 you can take to P&L. That means you can only credit the 0.1. Profit and loss will be 0.2, but from OCI you can only credit 0.1. The balance 0.1 is in profit and loss only. That, okay, the amount of whatever is there in the OCI. That is the meaning of this. Now we are coming to the statement of cash flow. So you have now understood how the 10 marks are given. If you see, it is cash received 0.5. Sorry, cash received, yes. If you see here, there is a thing. Okay, 10 million. And what is the interest? They are receiving interest at 5%. So if you take 5% of 10, it is 0.5 only. Okay. 10 into 5%, 0.5. That's how the cash value is 0.5. Okay. The amount that you have to pay. Cash received. Okay, it's a cash received, sorry. Cash received, but you have to deduct it. Because it will reduce the amount of your receive the amount of your financial asset. That means this financial asset is a bond. So from bond, it's like a liability. So from bond, the amount of cash that you have received will reduce the amount of bond that you will be receiving more, right, in the future. So 0.5 will be deducted. Okay. You have received this amount of cash already. So the 10 million cash spent on financial asset will be cash outflow. This 10 million, this 10 million. This is the bond. Cash spent on financial asset. This will be presented as cash outflow from investing activity. Okay. Why? You have given this bond to someone else. It's like you are giving loan to someone else. So it's an outflow for you because amount is going from you. You are not taking loan from someone, or you are not taking this bond from someone else. That's why this 10 million is an outflow. Understand this thing. Even though it's a financial asset, looks like why it's an outflow. You might be confused later why it's not an inflow, because you are giving it to someone else. You are giving, it's like you are giving 10 million loan to someone. So 10 million is from going from your pocket. They will pay later on. That's another issue. But now it's an outflow from investing activity and interest. So that's it for this question. We'll wrap up this question. what we have discussed. Classification between equity and debt. First requirement. Second, financial asset. The shares. It's a financial asset. Equity instruments, right? Financial assets which are equity instruments, and the third one is a financial asset which is a debt instrument and which is impaired. So these are the three things which we have covered in this question. Now see you in the next question. Until then, take care.